Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Airbnb just reported earnings, and the market didn't like their guidance for future growth, which was around 13% at the midpoint for the second quarter. And that certainly gave a lot of investors pause. Here's the thing. Airbnb still absolutely gushes cash and is sitting on a veritable mountain of money to deploy. I'm Jason Hall. This is The Smattering. And I've got Tyler Crow here with me. Tyler and I did a video about a month ago, and we talked about a warning sign for Airbnb and a thing that if they did, it would really be concerning for Tyler. Well, guess what? In this latest earnings call, management hinted that they might be about to do that thing. So I've got Tyler back here with me, and we're going to talk about what it is right now. Hey, Tyler.
I almost feel prophetic because my greatest fear for Airbnb is seemingly coming true. And management basically told us as such in this most recent quarterly conference call.
Let's go back to a month or so ago when we made the last video, and you had some great things to say about Airbnb. It's proven to be very sticky. They're one of these few SaaS platformy kind of things that's proven to have some really good economic moats. And your concern, Tyler, was that they were going to take this focus, this cash cow business, and then as growth started to slow, management was going to pop up. They were going to kind of look around a little bit and say, let's go find something else to buy. And that thing was going to start eroding returns and be a net destroyer of capital because they lost focus on what they figured out they were really good at.
Yeah, it's a story as old as time where a company has a great idea, it finds it to be incredibly profitable with it, and then for some reason latches on a bunch of other mediocre businesses, loses focus. And I almost pleaded with Airbnb's management on this last one and says, you do a really good thing, just keep on doing that, stay focused on it, and you've got cash, return it to shareholders. I know dividends and buybacks are not the coolest thing to do in Silicon Valley, but investors like them. Unfortunately, management kind of telegraphed it in this most recent call. CEO Brian Chesky, when asked about expanding beyond the core, here's the quote. It says, and then what we can do is go into adjacencies within our core, but then including that, expand beyond the core. And that to me was the most alarming thing I have heard because we don't know what that means. For a lot of investors, that says, great, we're going to restart this growth engine all over again. The revenue is going to accelerate again, and we're going to find this whole new avenue to conquer. But Jason, we've been studying companies for a long time. The first idea works really well. It does not guarantee in the slightest that the next idea is going to work well.
And I want to offer up a cautionary tale for a company that its core was a wonderful growth business for a very long time. And then when it started to shift into some of those adjacent areas, it ended up being a net destroyer of value, not just because a lot of the things that they didn't work out, but also because it took their eye off the ball and it took resources off of it as well. And that's Under Armour. This is a company that had a record of, I think it was over a decade, where every single quarter they grew revenue by 20% year over year. Not just the yearly revenue, but every single quarter they grew revenue 20% year over year. They started with apparel with that great shirt, just the t-shirt, and then they added other apparel, and then they got into shoes, and all of that worked really, really well. And then they started getting into connected fitness. It's this more adjacent thing, spent $600 or $700 million, maybe close to $1 billion to acquire these apps to build this ecosystem that was an abject failure. And they ended up writing off almost every dollar that they invested in it. And these are resources that they took away from the apparel business, the shoes, at the exact same time that a lot of their major retail distribution partners were struggling. Competition was higher. We saw a number of those retailers go out of business. We saw several fitness retailers completely liquidate. At the same time, all of their competitors were really focusing on keeping Under Armour from taking market share. And the stock really never fully recovered from those highs. So my concern with Airbnb is seeing a similar sort of thing happen, and that you take resources away from what we know is a very good profitable business, particularly when it's just starting to get to maybe like that first stage of maturity where you have a really large business at scale that's really profitable. And you've still got pretty good growth prospects from here, right? I anticipate that this should still be a double digit, maybe even low to mid teens growth business for a lot of years to come, for a lot of years to come. And when you already have such incredible operating leverage in your model, again, at scale today, this business generates 44% free cash flow. That is incredible. If you can grow your revenue between 10 and 15% a year and get just a little bit more operating leverage on it, you can grow earnings per share high teens or 20% per year. So there's tremendous potential to do that. And I agree with you. My biggest fear is that they shift into some of these adjacencies that on paper, like they pencil out really good, but they really don't create value for the core Airbnb customer in some way that makes the platform stickier, keeps them more engaged in the ecosystem of that app in some way that is better than an alternative. And my fear is that they're not going to do that.
And that the alternative is a very important point because, like you said, with Under Armour, everyone started to say we need to protect our market share or take Under Armour's market share when it was unfocused. Airbnb has done an incredible job at being ubiquitous in this industry, but it isn't the only one.
There's real competition there. Yes.
Any competitor looking at Airbnb's financials right now says we can take market share. So I would plead to management right now, do not go into adjacencies, don't expand the core. You need to defend this territory, defend this mountain that you stand upon tooth and nail. I hope that's where they go. And then you can turn this profitability flywheel into something that really does something for shareholders in the long term.